kind of crazy. You don't hear of things like Walmart closing.
America's retail apocalypse has reached a breaking point. Right now, Party City is liquidating all 850 stores nationwide, leaving thousands jobless. Luxury giant Saks is on the verge of collapse, with bonds trading at just 62 cents on the dollar. Even Walgreens, a pharmacy chain your family has trusted for decades, is shuttering 500 locations this year alone. Here are 20 big retail chains that are falling apart in 2025. Party City. Once the go-to destination for celebrations, Party City is now facing a total shutdown in 2025. This retail chain, known for party supplies, costumes, and decorations, has filed for bankruptcy for the second time in less than 2 years and is closing all 850 locations by February 2025. What many shoppers don't realize is just how quickly Party City's situation deteriorated. Despite being in business for nearly 40 years, the company has announced the closure of all its corporately owned stores. Driven by insurmountable financial and market challenges, Party City's debt burden reached $800 million, even after reducing it from $1.7 billion during its first bankruptcy in 2023. The impact on consumers has been immediate and concerning. "This is terrifying. What am I supposed to do now? Where am I going to get my party supplies from?" expressed one shopper on social media, highlighting the panic felt by many who relied on Party City for celebrations and events. What does it say about our economy when a retailer dedicated to celebrations can't survive? And if Party City, a chain that weathered decades of economic ups and downs, can completely collapse, what does that mean for other specialty retailers that millions of Americans depend on? Our next retail chain filed for Chapter 11 bankruptcy in September 2024 and has announced plans to close 601 stores in 2025, a massive reduction from its once thriving nationwide presence. Big Lots. One thing few people realize is how quickly Big Lots' financial situation deteriorated. After experiencing 16 consecutive quarters of sales declines, the company found itself drowning in debt, with $573 million in long-term obligations and another $250 million owed to vendors like Tempur Sealy and Serta Simmons. This financial strain has made it impossible for Big Lots to invest in store improvements or adapt to changing market conditions. The impact on the retail landscape has been severe. When compared to competitors, analyst Neil Saunders noted that Big Lots' product offerings became increasingly jumbled and muddled, creating a poor shopping experience. Many items at Big Lots could actually be found cheaper at Walmart, undermining the company's core value proposition as a discount retailer. As inflation continues to squeeze household budgets, discount retailers like Big Lots should theoretically thrive. So what does it mean when even these budget-friendly options are disappearing? Who will serve the needs of price-conscious shoppers in communities that are losing their only discount retailer? Up next is a consumer favorite, once a mall staple for trendy, affordable fashion. Forever 21 is winding down its U.S. operations after filing for bankruptcy. Forever 21. What many shoppers don't realize is that Forever 21's downfall stems largely from its inability to compete with ultra-fast fashion giants. The company has been blindsided by the meteoric rise of Chinese e-commerce platforms, Shein and Temu, which have redefined fast fashion with rock-bottom prices and rapid trend cycles. While Forever 21 sells women's jeans for around $30, $50, Shein and Temu offer similar styles for just $10, $20, making it nearly impossible for the mall-based retailer to compete. The financial impact has been catastrophic. Forever 21 entered bankruptcy with $1.58 billion in debt after losing over $400 million in the 3 years prior to 2025, including $150 million in 2024 alone. E-commerce sales have plummeted, with a 50% drop to just $142 million, demonstrating the company's failure to transition to digital shopping. If a retailer that was once considered too big to fail in the fashion world can collapse so dramatically, what does this mean for other mall-based clothing stores? And how will young shoppers who can't afford high-end brands but want trendy options beyond ultra-cheap fast fashion fill this gap in the market? Up next, this beloved crafting retailer is shuttering all of its approximately 800 stores nationwide in 2025, despite having emerged from Chapter 11 bankruptcy in 2024 without store closures. Jo-Ann Fabrics. What many craft enthusiasts don't realize is that Jo-Ann's financial troubles persisted even after its restructuring. A leaked memo revealed that sales collapsed prior to the bankruptcy, with reports of unpaid vendors and inventory shortages plaguing the company. Despite the craft boom during the pandemic, demand plummeted afterward, leaving Jo-Ann with declining revenue and excess inventory. The human cost extends beyond customers. Approximately 22,000 employees across all stores face unemployment, with many having dedicated decades to the company. One employee from a rural store posted online, "We're not just losing jobs, we're losing a community. Our customers came here not just to shop, but to connect with other crafters and get advice on their projects." As inflation continues to squeeze household budgets, hobbies and creative outlets become even more important for mental health and well-being. But if specialized retailers like Jo-Ann can't survive, what does this mean for Americans' access to creative pursuits? Will crafting become another hobby that's primarily accessible online, losing the tactile experience and community connections that made stores like Jo-Ann so valuable? Up next is Kohl's. once a reliable fixture in suburban shopping centers, closing 27 stores in 2025 as part of a long-term growth strategy following 24 closures in 2024. Kohl's. What many shoppers don't realize is that Kohl's financial situation is far more precarious than it appears. The company reported a 61% drop in operating income in Q4 2024, while its stock has plummeted nearly 70% over the past 2 years. Behind the scenes, CEO Corey Berry has warned that proposed tariffs on imports from China and Mexico, which account for most of the company's products, could significantly increase prices, further straining already cautious consumers. The impact on customers and employees has been significant. Shoppers in areas like Northport, New York, Apple Valley, Minnesota, Worcester, OH, and Gaithersburg, Maryland, have already lost their local Kohl's stores. Reports of understaffed locations and long wait times for customer assistance have become common, with some customers waiting 20 minutes for help, according to social media posts. For employees, the situation is increasingly dire. The company has laid off approximately 3,500 employees in 2024, with reports of replacing 1,200 store managers with computer vision technology. This technological pivot may streamline operations, but it has left thousands of workers without jobs and created a stressful, understaffed environment for those who remain. If a relatively stable retailer like Kohl's is struggling to this extent, what does that mean for similar mid-tier department stores? And as these stores vanish from suburban landscapes, will Americans increasingly find themselves with only 2 shopping options: luxury retailers or ultra-discount stores with nothing in between? Up next is a shocking one: Dollar General. Famously known for thriving in economic downturns, but now closing hundreds of stores across the country, Dollar General. What many budget-conscious shoppers don't realize is that approximately 25% of Dollar General's 8,700 US stores are actually unprofitable. The company's financial troubles have been mounting, with S&P Global Ratings downgrading Dollar General's credit rating in July 2024, citing high leverage and weak liquidity. Same-store sales fell 3.9% in Q4 2024, signaling a significant loss of customer traffic, despite its budget-friendly reputation. The impact on low-income communities has been particularly severe. In Memphis, Tennessee, 2 stores closed in April 2024 due to shoplifting, with employees reporting thieves taking more items than were sold. The Memphis Police Department recorded over a dozen shoplifting incidents at one store alone. These closures disproportionately affect rural and urban low-income areas, where Dollar General often serves as the only accessible source for groceries and household essentials. In a time of high inflation, when discount retailers should theoretically be thriving, what does Dollar General's retreat say about the state of America's low-income consumers? And as these stores disappear from communities with few other options, how will vulnerable populations access affordable necessities? Up next is the once iconic department store, JCPenney, closing several locations across states like California and Denver, Colorado, as it continues to struggle after emerging from its 2020 bankruptcy. JCPenney. What many loyal shoppers don't realize is how precarious JCPenney's recovery has been. Despite being acquired by Simon Property Group and Brookfield Properties in 2020, the company has seen a 10% revenue decline since 2019, with CEO Mark Rosen acknowledging significant missteps in women's clothing, which customers have found overpriced, lacking differentiation, and bland. This failure to refresh its product offerings has left JCPenney struggling to define its place in the retail landscape. The retailer's decline reflects broader shifts in American shopping habits. With its heavy dependence on mall traffic, 411 of its 553 stores were in malls as of 2023. JCPenney has been hit hard by the projected closure of 25% of US malls by 2027. One shopper in rural Virginia commented online, "When our JCPenney closes, we'll have to drive over an hour to find anything similar. Not everyone can just shop online." If a department store chain that has existed for over a century cannot adapt to today's retail environment, what hope is there for similar retailers? And as these middle market options disappear, will Americans increasingly find themselves with a widening gap between luxury and discount shopping, with few options in between? Up next, this pharmacy giant plans to close 500 stores in 2025, with an additional 1,200 closures planned over the next few years. Walgreens. What many regular customers don't realize is that approximately 25% of Walgreens stores are currently unprofitable, driving this unprecedented contraction. The company reported a shocking net loss of $265 million in the first quarter of 2025, despite a 7.5% revenue increase to $39.5 billion. By the second quarter, the situation had deteriorated further, with a massive operating loss of $5.6 billion. The closures are already affecting communities across the country. Walgreens is closing 2 stores in New Jersey Jersey, and Walgreens is closing 500 stores nationwide, including several in Tennessee, read headlines from local news outlets highlighting the widespread impact. Specific closures include 12 stores in San Francisco, 5 in Chicago, and others in cities like Oakland and Augusta, scheduled between February 17th and 27, 2025. For patients who rely on Walgreens for medications, these closures create serious healthcare access issues. In some neighborhoods, particularly in rural or underserved urban areas, the loss of a Walgreens pharmacy can create what health experts call pharmacy deserts, where residents may need to travel miles to fill prescriptions. One elderly patient in Chicago told local news, "I've been going to this Walgreens for my heart medication for 15 years. Now I don't know how I'll get my prescription since I don't drive anymore." If a healthcare necessity like pharmacies is retreating from communities nationwide, what does this say about our healthcare infrastructure? And as these accessible healthcare touchpoints disappear, how will vulnerable populations, particularly elderly and low-income Americans, maintain access to critical medications and health services? Up next is another pharmacy chain is closing or selling all of its remaining 1,245 stores across 15 states after filing for Chapter 11 bankruptcy on May 5th, 2025, its second bankruptcy filing in less than 2 years. Rite Aid. What many don't realize about Rite Aid's collapse is how quickly its financial situation deteriorated after emerging from its first bankruptcy. Despite slashing $2 billion in debt in 2024, the company still carried $2.5 billion in debt and was unable to secure additional financing, leaving it with no choice but to liquidate. S&P Global's CC+ rating on negative watch cited less than adequate liquidity and uncertainty over meeting obligations, including a $120 million interest payment due in June 2025. The impact on communities has been immediate and concerning. Rite Aid is closing or selling all of its remaining stores after filing for bankruptcy protection for the second time in 7 months, reported USA Today, highlighting the scale of the closures. The shuttering of 347 locations in California and 178 stores in New York has left significant gaps in local pharmacy access. When essential services like pharmacies are disappearing from communities nationwide, what does this tell us about the state of both retail and healthcare in America? And if established pharmacy chains can't survive, who will ensure medication access for vulnerable populations in underserved areas? Up next is Canada's oldest retailer, founded in 1670, and is now liquidating all its stores after filing for creditor protection in March 2025, bringing an end to 355 years of retail history. Hudson's Bay. What many don't realize about Hudson's Bay's collapse is the catastrophic scale of its financial implosion. A leaked memo revealed that sales plummeted 33% year over year in 2024 to $1.11 billion from $1.65 billion, with e-commerce sales dropping nearly 50% to $142 million from $300 million. The company is drowning in over $1.1 billion in debt owed to nearly 2,000 creditors, including major brands like Ralph Lauren, Chanel, and Estée Lauder. The human cost extends far beyond shopping inconvenience. Approximately 9,364 employees face unemployment, with no severance details provided. One longtime employee shared anonymously with Canadian media, "We're not just losing jobs, we're losing a Canadian institution. Some of us have worked here for decades, and now we're being thrown into a job market with few retail opportunities." When a retailer that has survived for over 3.5 centuries collapses in a matter of months, what does that tell us about the fundamental shifts in our economy? And if a store that weathered world wars, the Great Depression, and countless recessions can't survive in 2025, is any retail institution truly secure? Our next entry is an electronics retail giant who is closing 10 to 15 stores in 2025, following 24 closures in 2024, as it struggles with declining consumer electronics demand and fierce online competition. Best Buy. What most shoppers don't realize is how significantly Best Buy's financial performance has deteriorated. The company's revenue fell 3.4% to $14.2 billion in fiscal 2024, with comparable sales down 2.9%. Even more alarming, operating income dropped 61% in Q4 2024, driven by lower sales and higher costs. The company's stock has plummeted nearly 70% over 2 years, closing at $72.59 on January 28, 2025, down from a 52-week high of $168.07. The store closures are already affecting communities across the country. Best Buy is closing 15 stores in 2,025 inches, reported industry news sources, with locations in Northport, New York, Apple Valley, Minnesota, Worcester, OH, and Gaithersburg, Maryland, among those shuttering. The company's decision to cease selling DVDs and other physical media in 2024 has particularly impacted collectors and those in areas with limited internet access. For employees, the situation is increasingly dire. Best Buy laid off approximately 3,500 employees in 2024, with reports of replacing 1,200 store managers with computer vision technology. One employee wrote on Reddit, "Skeleton crews can't provide the service customers expect. We're constantly apologizing for wait times and out-of-stock items while management keeps cutting hours." If a specialized retailer like Best Buy, once considered the definitive electronic shopping destination, is struggling to this extent, what does that mean for consumer access to technology and expert advice? And as these stores disappear from communities, who will serve the needs of less tech-savvy customers who rely on in-person assistance rather than online shopping? The next discount retailer is closing or selling hundreds of stores amid a pending sale, continuing a troubling trend that began with the closure of 600 locations in 2024. Family Dollar. What many shoppers don't realize is the severe financial distress behind these closures. The parent company, Dollar Tree, posted a staggering $1.71 billion net loss in Q4 2023, largely attributed to Family Dollar's underperformance. Despite carrying approximately $800 million in debt after its 2023 bankruptcy restructuring, Family Dollar continues to struggle. With inventory issues, vendor payment problems, and declining same-store sales, the impact on communities has been significant. Family Dollar is closing hundreds of stores, reported USA Today, highlighting closures in areas already lacking affordable shopping options. In Memphis, Tennessee, 2 stores closed in April 2024 due to shoplifting, with employees reporting thieves taking more items than were actually sold. For low-income shoppers, particularly in rural and urban food deserts, Family Dollar often represents one of the few accessible options for groceries and household essentials. One customer from an affected neighborhood posted online, "Without Family Dollar, I'll have to take 2 buses to get basic necessities for my family. That's time and money I don't have." In a time when inflation is already stretching budgets thin, what happens to vulnerable communities when their most affordable shopping options disappear? And if discount stores designed to serve the neediest populations can't survive, what does that say about America's widening economic divide? Up next is a Saks Global, a luxury retail conglomerate operating with bonds trading at just 62 cents on the dollar and a CCC Plus credit rating on negative watch. Saks Global. What many luxury shoppers don't realize is the severe financial distress lurking behind Saks Global's elegant storefronts. The company faces a liquidity crisis with only $350, $400 million in available cash, but must make a $120 million interest payment due in June 2025. Even more troubling, Saks Global has an 18-month backlog of unpaid vendor bills, with some designers owed up to 1.2 million euros, straining relationships with luxury brands. The operational impact is already visible to shoppers. Saks Global closed Neiman Marcus's 110-year-old Dallas flagship on March 31st, 2025, along with its Dallas corporate office in February. Saks Fifth Avenue's Union Square store in San Francisco and Worth Avenue location in Palm Beach have also shuttered, with rumors of Toronto flagship closures circulating. For employees, the situation is deteriorating rapidly. Approximately 5% of Saks Global's U.S. corporate workforce, about 1,160 of 23,263 employees, was laid off in February 2025, primarily affecting finance, legal, and operations teams. Store staff face increasing uncertainty as sales continue to decline, with Saks Fifth Avenue reporting double-digit quarterly drops since fall 2023 and Neiman Marcus declining since late 2022. If luxury retail, traditionally more resilient during economic downturns, is faltering to this degree, what does that indicate about the overall health of consumer spending? And as high-end department stores struggle, will luxury shopping increasingly become an exclusive online experience, further widening the gap between digital and physical retail? Up next is the largest musical instrument retail chain in the United States, Guitar Center. The retail chain has been flagged by both Moody's and S&P Global as at high risk of bankruptcy due to approximately $1.1 billion in debt and declining sales. What many musicians don't realize is how quickly Guitar Center's financial situation has deteriorated. The company's bonds have plummeted to concerning levels, and according to credit agencies, Guitar Center faces looming debt maturities in 2026 with high leverage. This comes despite a temporary 6.6% holiday sales increase in 2024, which wasn't enough to offset the broader decline in the musical instruments retail market, which dropped 3% from $7.5 billion in 2023 to $7.3 billion in 2024. The impact is already visible with the closure of stores in West Los Angeles and Gilroy, California in January 2025, resulting in 62 layoffs by March 10, 2025. These closures, described as part of ongoing business processes, signal the beginning of what analysts fear could be a larger contraction. If a specialty retailer like Guitar Center, which survived the 2020 pandemic bankruptcy, is struggling in 2025, what does this mean for other niche retailers? And as these specialized stores disappear, will musicians increasingly lose the hands-on shopping experience that's crucial for selecting instruments, potentially dampening musical education and creativity in communities nationwide? Our number at home 15 is the home decor retail. At Home. This home decor retail chain has been flagged by credit rating agencies Moody's and S&P Global as at high risk of bankruptcy, struggling with volatility in the home furnishings sector and reduced consumer spending on non-essentials. What many shoppers don't realize is that At Home is facing significant financial distress despite its large format stores and affordable home goods positioning. The broader home furnishings market contracted by 5.4% to $74.4 billion in 2024, driven by reduced discretionary spending and a stagnant housing market with mortgage rates at 6.8% and existing home sales down 4.8% to 3.9 million units. The approximately 4,000 at-home employees nationwide face increasing uncertainty, with store staff reporting concerns about job security and reduced hours. A former employee wrote on a job board, "The writing was on the wall when they started cutting hours dramatically. Even successful stores were running on skeleton crews." In a housing market where many Americans are unable to move due to high mortgage rates and instead focus on upgrading their current homes, what does the struggle of a home decor retailer like At Home tell us about consumer priorities? And if affordable home styling options disappear, will home decor become another luxury that's increasingly out of reach for middle-income Americans? Up next is Karate Retail Group, who faces severe financial distress, with concerning credit ratings from S&P Global suggesting potential bankruptcy risk in 2025. Karate Retail Group. What many television shoppers don't realize is the magnitude of Karate's financial troubles. The company reported a 10% revenue decline to $1.6 billion in Q4 2024, with a staggering 200. Even more alarming, Karate's bonds are trading at distressed levels, and the company's stock was transferred to the Nasdaq Capital Market in December 2024 after failing to maintain a $1 minimum bid price. For Karate's 23,000 plus employees, the situation is precarious. The company reduced nearly 10% of its corporate workforce in January 2025, and further cuts are expected as financial pressures mount. One employee shared anonymously online, "The morale is terrible. We're seeing constant restructuring and cost cutting while executives get millions in compensation. Everyone's updating their resumes." The human impact extends to loyal customers, particularly older shoppers who have relied on QVC and HSN for decades. A frequent viewer posted on a shopping forum, "QVC has been my companion for years. I know the hosts by name and look forward to certain shows. Online shopping isn't the same interactive experience for me. If TV shopping giants that have been household names for generations are faltering, what does this mean for the future of interactive retail? And as these platforms struggle, will older consumers who prefer televised shopping experiences be left behind in an increasingly digital retail landscape?" Up next is the mail staple Express, which continues to close stores in 2025. Express. What many shoppers don't realize is that Express entered bankruptcy with $1.2 billion in liabilities and $1.3 billion in assets, highlighting the severe financial distress that years of declining sales had created. The company's revenue has fallen 10% since 2019, with CEO Stuart Glendinning admitting significant missteps in women's clothing, which customers found overpriced, lacking differentiation, and bland. The impact has been immediate and widespread. Dollar Tree and Family Dollar closing 1,000 stores, Express closing 95 stores, and all 10 UpWest locations, reported industry news sources, highlighting the scale of the retail contraction. Express closed 95 stores, 17% of its 553 total, and all 10 UpWest locations in 2024, with closing sales starting April 23, 2024. If a mall staple like Express, once a reliable presence in shopping centers nationwide, can't survive in today's retail environment, what hope is there for similar mall-dependent fashion retailers? And as these mid-tier options disappear, will shoppers increasingly find themselves forced to choose between ultra-cheap fast fashion or high-end luxury, with fewer options in between? Up next is Rue21, the teen-focused clothing retailer who declared bankruptcy last year. Rue21. What many shoppers don't realize is how complete Rue21's collapse has been. Despite Canadian retailer YM Inc. reopening 14 stores in late 2024, less than 3% of the former footprint, the company's core business has effectively ceased to exist. Rue21 entered its 2024 bankruptcy with approximately $194.4 million in debt, and court documents revealed that liquidation was deemed more lucrative than a potential asset sale, as no buyer offered more than the value of inventory. The human toll has been substantial, with approximately 4,900 employees losing their jobs. One former store manager shared on social media, "Many of us had been with the company for years. We were told our stores were closing with barely 2 weeks' notice. Most of my team is still looking for work months later." Rue21's failure failure to compete with fast fashion giants like Shein and Temu highlights the brutal reality of today's retail landscape. Analyst Neil Saunders noted Rue21's growing irrelevance among teens, who increasingly prefer these cheaper and more interesting online platforms. If a retailer specifically targeting younger shoppers, supposedly the most engaged consumer demographic, can't survive, what does this mean for the future of teen-oriented retail? And as affordable mall options disappear, how will young people with limited budgets find age-appropriate clothing in physical stores? Up next is the popular office supply retail chain, Office Depot. They are experiencing declining sales and implementing aggressive cost-cutting measures through its Project Core initiative, following the closure of 58 stores in 2024. What many shoppers don't realize is how significantly Office Depot's financial performance has deteriorated. The ODP Corporation, Office Depot's parent company, reported a 10% revenue drop to $1.6 billion in Q4 2024, with a staggering $274 million net loss for the full year. Even more concerning, the company recorded $12 million in non-cash asset impairments for retail store leases, signaling ongoing challenges with its physical locations. For employees, the situation is increasingly grim. Reddit posts describe skeleton crews and no raises for store-level employees in 2025, with outdated equipment, broken cash registers, and malfunctioning copy centers creating a challenging work environment. One employee wrote, "We're expected to do more with less every day, while watching stores close around us. It's only a matter of time before mine is next." If specialized retailers like Office Depot, once considered essential for businesses and students, continue to contract, what does this mean for communities' access to critical supplies? And as these stores close, will consumers in smaller communities be forced to rely entirely on online ordering for essential office and school supplies? Our next entry is the iconic department store, Macy's. This chain is closing 66 stores in 2025 as part of a plan to shutter 150 underperforming locations by 2026, following a concerning 4.3% revenue decline to $7.77 billion in Q4 2024 and a $274 million net loss for the year. What many longtime Macy's shoppers don't realize is that beyond just store closures, the company is facing a perfect storm of challenges. In November 2024, Macy's uncovered a $151 million accounting scandal involving a single employee falsifying small package delivery expense accruals, delaying Q3 earnings, and damaging investor confidence. This contributed to a 20% stock drop over the past year, compounding the retailer's struggles. The retailer's challenges reflect broader shifts in American shopping habits. With its heavy dependence on mall traffic, Macy's has been hit hard by the projected closure of 25% of U.S. malls by 2027. Analyst Neil Saunders criticized Macy's for neglecting store quality, with outdated interiors, broken fixtures, and cluttered aisles driving customers to competitors like Target. If an American retail institution like Macy's, a brand that has defined department store shopping for generations, is faltering to this degree, what does this mean for the future of traditional retail? And as these department stores disappear from American malls and shopping districts, are we witnessing the end of an era in American consumer culture? If you enjoyed this video, check out our other awesome videos on the channel. Thanks for watching, and we'll see you next time.
Another major corporation is announcing layoffs. Hewlett-Packard is cutting as many as 6,000 jobs.
Financial experts are sounding the alarm of the potential impacts of the global trade war sparked by President Trump's tariffs.
This isn't just another layoff. It's signaling an impending economic war, and American workers are on the front lines.
Did you ever think when you voted for President Trump that things were going to cost you more and you're going to lose money?
I never thought I was going to lose this much money, this fast.
Even the workers who voted for Trump are now facing the consequences of the very tariffs meant to protect them. Let's get into it. The braking situation. In today's tech landscape, a tectonic shift is reshaping the future of American manufacturing and jobs. HP, the tech giant known for personal computers and printers, has announced plans to lay off up to 2,000 more employees, bringing their total job cuts to a staggering 9,000, representing 15.5% of their global workforce. This dramatic action comes directly in response to the escalating trade war and tariff policies that have fundamentally altered the economics of global manufacturing. The announcement arrived just hours after Trump's sweeping tariff implementation, creating immediate ripple effects across the technology sector. The shockwaves are already being felt throughout the industry, with HP's shares falling 3.5% in extended trading following the announcement, a clear signal of market uncertainty. HP's decision speaks to a broader economic crisis unfolding in real time across America's manufacturing sector. While not closing factories outright, the company is executing a bold and unprecedented strategic maneuver, relocating 90% of its North America-focused focused manufacturing outside of China by October 2025, a move directly aimed at avoiding the crushing impact of tariffs on Chinese imports. This isn't simply a cost-cutting measure, it represents a complete reconfiguration of a global supply chain built over decades. HP CEO Enrique Lores has emphasized that the company has been enhancing supply chain resilience over recent years, establishing factories in countries like Thailand, with plans to shift at least 50% of notebook manufacturing out of China within 2 to 3 years. But the accelerated timeline speaks to the urgency of the situation. The human toll of these decisions is severe and immediate. Factory workers, supply chain personnel, support staff, HR positions, and those in legacy tech roles are all targeted in this strategic culling. These aren't just statistics, they represent American livelihoods suddenly thrown into uncertainty as geopolitical forces reshape the employment landscape. The economic pain extends far beyond HP's workforce. Morgan Stanley research indicates that the added tariff cost could equate to nearly the entirety of HP's expected net income in 2025, a staggering financial burden that threatens the very viability of American technology manufacturing. For the quarter ending April 2025, HP's earnings per share outlook was 75.85 cents, falling below analyst expectations of 85 cents, directly attributed to rising component costs and tariffs on Chinese goods. This isn't happening in isolation. Across the manufacturing sector, a similar story is unfolding with frightening speed and scale. Stellantis has temporarily laid off approximately 900 U.S. workers across 5 plants in Michigan and Indiana due to tariff impacts. The affected facilities include Warren Stamping, Sterling Stamping, Indiana Transmission Plant, Kokomo Transmission Plant, and Kokomo Casting Plant, representing a cross-section of America's automotive manufacturing backbone.
Fear and frustration outside this Stellantis plant in Windsor, Ontario.
Could be 2 weeks, could be 2 months, who knows? We are very worried.
The immediate consequences are stark and troubling. Fear and uncertainty grip workers across these sectors, with union protections only providing temporary relief before the economic reality sets in. The anxiety is palpable as workers face the prospect of lost income and an uncertain future in a rapidly changing job market. Beyond individual companies, entire industry supply chains are fracturing under the pressure of these tariffs. The automotive sector has been particularly hard hit, given its reliance on cross-border supply chains. For instance, Nissan's Infiniti brand paused production of 2 Mexico-built crossovers for the U.S. market due to the 25% tariffs. The economic fallout extends to increased costs for consumers. The Consumer Technology Association estimates that proposed tariffs could increase laptop and tablet prices by up to 46% and smartphones by 26%. These aren't theoretical concerns. Acer has already announced a 10% price hike for U.S. products due to tariffs, indicating an industry-wide pressure that will soon hit American consumers directly in their wallets.
Canada's auto industry says as tariffs stack up, so will vehicle prices.
These tariffs are going to drive up new vehicle prices by between $4,700 US and $10,000 US.
Fears of consumers putting the brakes on new purchases are already having an effect south of the border.
The broader economic implications are deeply concerning. Goldman Sachs projects that tariffs will create approximately 100,000 manufacturing jobs, but could destroy 500,000 jobs across other sectors, resulting in a net loss of 400,000 jobs. This stark calculation reflects the trade-off between protecting specific domestic industries and the broader economic cost of reduced trade. Even more alarming, economic experts suggest that job losses could be in the millions due to the tariffs. The unemployment rate could rise from 4.2% to 4.7% by the end of 2025, representing approximately 500,000 people affected. This projection is based on increased costs for businesses and potential reductions in hiring, a ripple effect that threatens to undermine years of economic progress. The global perspective is equally troubling. The IMF has downgraded its global growth forecast to 2.8% for 2025, down from 3.3% in 2024, attributing much of this to U.S. tariffs. This slowdown is expected to persist, with inflation forecast rising to 4.3% in 2025 and 3.6% in 2026, eroding purchasing power and reducing consumer spending. The uncertainty created by these tariffs has sent shockwaves through financial markets. The S&P 500 suffered its worst day since 2020, with European stocks closing 2.7% lower due to tariff-related reactions. Small-cap stocks, as measured by the Russell 2000, entered a bear market, becoming the first major U.S. stock measure to do so, highlighting the breadth of the sell-off. The impact on global trade is equally severe. Under current conditions, global merchandise trade volume is likely to fall by 0.2% in 2025 with severe downside risks, including the potential reactivation of reciprocal tariffs, which could lead to a 1.5% decline. North America is particularly hard hit, with exports forecasted to drop by 12.6% and imports by 9.6%, directly impacting workforce-related industries. The analysis and ramifications. Behind the headlines, HP's strategic response to tariffs reveals a sobering economic reality. The company is aiming to save an additional $300 million by the end of fiscal 2025 through these cost-saving measures, but will incur approximately $150 million in restructuring charges, primarily from cash labor costs. This financial calculus demonstrates the brutal arithmetic facing American technology companies caught in the crossfire of trade policies. The tariff impact on HP's bottom line is severe and immediate. For Q1 2025, HP reported $13.5 billion in revenue, up 2.4% from the prior year period, yet the company's profit outlook remains constrained by tariff pressures. HP's Future Ready transformation plan, initially targeting $1.4 billion in savings, has now been revised upward to $1.9 billion, a direct response to the escalating economic pressures created by tariffs. But the consequences extend far beyond corporate balance sheets. For American workers, the outlook is increasingly grim. Research suggests tariffs will reduce hours worked by 664,000 full-time equivalent jobs in 2025, based on historical trends from previous trade wars. The human toll is devastating, with workers in manufacturing, logistics, and support roles facing sudden unemployment and uncertain futures.
Jim is a Republican who voted for Donald Trump 3 times.
How do you feel about your vote for Donald Trump now?
Well, I feel like perhaps I should have considered some other options.
Among other things, Jim imports packaging supplies for his honey, so he's paying real close attention to the tariffs Trump just put in place.
The impact on specific sectors is particularly severe. In the logistics industry, a 35% drop-off in imports could lead to a 5% to 6% decline in total freight across the U.S., potentially resulting in 400,000 to 500,000 job losses in logistics alone. This cascading effect threatens to undermine entire sectors of the economy that depend on the smooth functioning of global supply chains. A particularly troubling aspect of this economic disruption is the potential for product shortages reminiscent of the pandemic era. Supply chain logistics group Vision reports a drastic drop in shipping container bookings from China to the U.S. in recent weeks, while data from the Port of Los Angeles shows a declining volume of imports as well. This significant reduction in imports threatens to create widespread product shortages across multiple categories.
Financial experts are sounding the alarm of the potential impacts of the global trade war sparked by President Trump's tariffs. They say that it could trigger a slump in shipments to the U.S. and empty shelves in stores. Supply chain logistics groups Vision reports a drastic drop in shipping container bookings from China to the U.S. in recent weeks, as we see here in this chart.
For consumers, the impact will be felt directly in their wallets and in product availability. The Tax Foundation estimates an average tax increase of nearly $1,300 per U.S. household in 2025 due to tariffs. This reduced disposable income will potentially affect jobs in consumer-facing industries, creating a dangerous downward economic spiral. Even more alarming is the potential for product shortages that could affect essential items. As early as June 2025, consumers may begin to notice intermittent shortages, with more significant disruptions expected during the back-to-school shopping season in August. Products like backpacks, school supplies, batteries, nutritional supplements, and over-the-counter medicine may be unavailable or in limited supply. Even holiday goods for Christmas 2025 could be affected, despite the seemingly distant timeline, due to the long lead times required for global supply chains. The disruption extends beyond retail goods to critical components for machinery and infrastructure. Air conditioning repair parts, for instance, could become scarce, leading to situations where essential home repairs become impossible due to unavailable components, a particularly concerning prospect during summer months. From a macroeconomic perspective, the situation appears increasingly dire. Penn Wharton budget model projections indicate that tariffs could reduce GDP by 5.1% to 6.3% by 2054, depending on how the burden is distributed between consumers and businesses. Wages could fall by 3.9% to 5.8% over the same period. These reductions are noted to be more than twice as severe as those from a revenue-equivalent corporate tax increase from 21% to 36%, highlighting the tariffs' distortive impact on the economy. The global dimensions of this crisis cannot be overstated. China is refusing to negotiate with President Trump on U.S. tariffs, escalating the trade war to new heights by telling Chinese airlines not to order jets from Boeing, America's biggest exporter. This retaliation extends to critical rare earths, Hollywood films, and fentanyl talks, creating a multi-layered economic confrontation with far-reaching implications.
China is refusing to negotiate with President Trump on U.S. tariffs. In fact, the nation is taking the trade war to a new height. China is refusing to accept deliveries of Boeing jets. NBC's Janice Mackey-Frayer reports the move would not just be a blow to America's largest exporter, but also to the U.S. economy.
California is fighting back against the tariff authority, with Governor Gavin Newsom filing a lawsuit in federal court suing Trump over his use of emergency powers to enact sweeping global tariffs. The lawsuit argues Trump lacks the authority to enact such sweeping tariffs, claiming such action requires congressional approval. This legal challenge adds another layer of uncertainty to an already volatile economic situation. The impact on specific industries is particularly severe. Manufacturing firms, concentrated in tariff-exposed regions, are significantly more likely to reduce hiring, with about 32% reporting plans to decrease employment due to tariff concerns. Similarly, firms in construction, mining, and utilities express notable employment concerns, with nearly 22% expecting decreased hiring, and retail and wholesale trade seeing about 1/4 anticipating hiring declines. For small businesses and farmers, the consequences are especially dire. Jim Hartman, a honey farmer in Linden, North Carolina, faces a potential loss of $150,000 annually, approximately 50% of his revenue, due to federal program cuts associated with tariff policies. His story illustrates the direct impact on rural America, where agricultural producers are caught between rising costs and diminishing revenues.
For a lot of other local farmers around here, it was a major source of reliable revenue. For me, it's going to cost me around $150,000 a year.
$150,000.
Yeah, roughly 50% of my revenue.
The situation for soybean farmers is equally troubling. Scott Metzger, an Ohio soybean farmer and board member for the American Soybean Association, describes the tariffs as an alarming concern in an already tight farm economy. With China purchasing 52% of American soybean exports last year, the tariffs create a dangerous uncertainty for farmers who have not yet recovered from previous trade wars. In the broader context of American manufacturing, HP's decision to relocate production outside China rather than returning it to the United States underscores a troubling reality. Despite rhetoric about bringing manufacturing back to America, the economic incentives created by tariffs are instead pushing production to third countries like Vietnam, Thailand, and Mexico. HP is making some investments in U.S. manufacturing, particularly in Corvallis, Oregon, with up to $50 million in funding from the CHIPS and Science Act, creating over 100 manufacturing jobs. But this represents a fraction of the production being relocated globally. The financial markets have registered severe concerns about these economic trends. The chip-making sector was particularly hard hit, with the VanEck Semiconductor ETF shedding nearly 7%. Companies saw steep declines. Qorvo and Micron Technology plunged more than 12%, while Qualcomm, Broadcom, and Lam Research each dropped over 7%. Nvidia and Taiwan Semiconductor Manufacturing slumped more than 6%, and Advanced Micro Devices fell about 5%. These drops were driven by fears that tariffs would quell demand for technology gadgets and electronics. Perhaps most concerning is the risk of a broader economic downturn. Economists warn that tariffs could lead to stagflation, rising inflation alongside higher unemployment. Gregory Dacco from EY predicts consumer prices could accelerate by 1 percentage point by year-end, pushing inflation close to 4%, creating additional pain for American consumers already struggling with elevated prices. Jason Furman emphasizes that tariffs create both a supply shock, increasing prices and unemployment, and a demand shock due to uncertainty, further raising unemployment, potentially causing a recession in the short term. The future implications. As the dust settles on HP's dramatic announcement, a troubling question emerges. Are we witnessing just the beginning of a much larger economic transformation? The evidence suggests this may indeed be the case, with implications that will reverberate through the American economy for years to come. The IMF has downgraded its global growth forecast to 2.8% for 2025, down from 3.3% in 2024, attributing much of this slowdown to U.S. tariffs. This global deceleration threatens to undermine economic progress across multiple sectors, creating a challenging environment for job creation and wage growth. For American workers, the outlook is increasingly bleak. The Richmond Fed reports a relative employment decline of about 1.8% to 2.6% due to tariffs, translating to approximately 220,000 to 320,000 jobs lost, especially when accounting for China's retaliatory measures. The Budget Lab at Yale provides an even more alarming assessment, estimating that all 2025 tariffs will increase the unemployment rate by 0.6% percentage points by the end of 2025, resulting in payroll employment being 740,000 to 770,000 lower. The human dimension of these statistics is powerful and disturbing. Consider the personal testimony of farmers like Jim Hartman, whose livelihood has been directly impacted by tariff policies. For consumers, the consequences will be both immediate and lasting. JP Morgan Research estimates that the new tariffs could raise PCE prices by 1.5% in 2025, reflecting broader inflationary effects that will erode purchasing power across the economy. The Consumer Technology Association warns of potentially dramatic price increases, with laptop and tablet prices potentially jumping by up to 46% and smartphones by 26%, directly impacting Americans' access to essential technology. The disruption to supply chains threatens to create significant product shortages reminiscent of the pandemic era. Industry experts warn that these shortages could appear as early as June 2025, with more significant disruptions expected during the back-to-school shopping season. The situation is so severe that supply chain experts are recommending consumers begin Christmas shopping immediately, as holiday goods may be unavailable or in limited supply by the traditional shopping season.
So I'm going to say something that is absolutely going to seem absurd, but there is a potential of what's happening right now, even if we get a deal in the next 3 months. I'm specifically talking about China. Even if we get a deal, you could have problems getting your hands on holiday goods. And so things about Christmas, those Christmas gifts, it sounds absurd, but you might want to start doing your Christmas shopping right now, because when you go to shop in the stores in October, November, and December, the items that you would expect to normally see may not be there, or the selection may not be there.
The vulnerability of specific sectors is particularly concerning. According to the CEPR, sectors like electrical equipment and electronics and transport equipment, with a GVC dependency of around 30%, face sharp falls in production due to tariff-induced disruptions. Global trade is expected to contract by 5.5% to 8.5% depending on the scenario, with GVC trade shrinking by 2% more than direct bilateral trade. Transport equipment and electrical equipment and electronics could contract by 16% and 12% respectively in a full plus retaliation scenario, likely leading to significant job losses in these sectors. Small and vulnerable economies face particularly severe risks from these trade disruptions. The UNCTAD highlights that 28 trading partners contribute less than 0.1% each to the total U.S. trade deficit, yet face significant tariffs, hindering their exportability. For countries like Madagascar, Côte d'Ivoire, Ghana, Zambia, and the Democratic Republic of Congo, which depend heavily on exports to the U.S. market, the tariffs threaten to devastate local economies and exacerbate global inequality. The risk of a broader economic downturn looms large over these specific sectoral impacts. Economists warn that tariffs could lead to stagflation, rising inflation alongside higher unemployment. Jason Furman emphasizes that tariffs create both a supply shock, increasing prices and unemployment, and a demand shock due to uncertainty, further raising unemployment, potentially causing a recession in the short term, leading to worse job outcomes long term. The financial markets have already registered severe concerns about these economic trends. The S&P 500 suffered its worst day since 2020, with European stocks closing 2.7% lower due to tariff-related reactions. Small-cap stocks entered a bear market, becoming the first major U.S. stock measure to do so, highlighting the breadth of the sell-off. For HP and similar technology companies, the tariff impact creates a troubling dilemma. Morgan Stanley research indicates that the added tariff cost could equate to nearly the entirety of HP's expected net income in 2025, a staggering financial burden that threatens the very viability of American technology manufacturing. Companies face a stark choice: absorb these costs and devastate profitability, pass them on to consumers through higher prices, or restructure global operations to avoid the tariffs entirely. HP's decision to pursue the third option reflects a pragmatic assessment of the economic realities, but carries significant consequences for American workers and consumers. The automotive sector provides a parallel example of these challenges. Stellantis temporarily laid off approximately 900 U.S. workers across 5 plants in Michigan and Indiana due to reduced production at their Canadian and Mexican plants, prompted by the 25% tariffs on imported vehicles. Most workers are protected from immediate pay loss due to union contracts, but prolonged shutdowns could risk lost income, illustrating the personal cost of these policy decisions.
Layoffs also beginning in the U.S. Midwest and Mexico.
I'm not surprised that you're seeing immediate reactions. This is what the U.S. policy will do.
The situation for agricultural producers is equally challenging. Scott Metzger, an Ohio soybean farmer serving on the board of directors for the American Soybean Association, expresses deep concern about the tariffs' impact on an already tight farm economy. He warns that if tariffs continue into the fall or next year, some farms could go out of business, with the next generation potentially unable or unwilling to continue in agriculture. The impact of last year's drought, which reduced his crop by approximately half, compounds the financial strain created by tariffs.
A fear that we have if this continues into the fall or even into next year, there's a potential that, there'll be some farms go out of business. You could have the next generation not want to come back or not able to come back just because of the economies or the farm situation in general. And adding these tariffs to this, there's just no room for error. But personally, in our operation in the state of Ohio last year, we were in extreme drought. And we roughly had half of a soybean crop and a corn crop last year.
The legal challenges to these policies add another layer of uncertainty. California Governor Gavin Newsom is suing Trump over his use of emergency powers to enact sweeping global tariffs, arguing that such action requires congressional approval. This legal challenge could potentially invalidate or modify the tariff structure, creating additional volatility for businesses attempting to plan their operations. Meanwhile, China's refusal to negotiate with President Trump on U.S. tariffs further complicates the situation. By targeting Boeing, America's biggest exporter, and placing export controls on critical rare earths, China has signaled a willingness to engage in a prolonged economic confrontation with potentially devastating consequences for global trade. The broader economic narrative emerging from these developments is deeply troubling. Far from restoring American manufacturing supremacy, tariffs appear to be accelerating a global reorganization of production that may leave the United States increasingly isolated and economically vulnerable. The interconnected nature of modern supply chains means that disruptions in one sector quickly cascade through the entire economy, creating widespread uncertainty and volatility. For HP specifically, the future remains uncertain. The company is modernizing its facility in Corvallis, Oregon, with up to $50 million in funding from the CHIPS and Science Act, creating over 100 manufacturing jobs. However, this represents a small fraction of the production being relocated globally, underscoring the limited impact of current policies on reshoring manufacturing to the United States. The human cost of these economic transformations cannot be overstated. Beyond the statistics and projections lie real people and communities facing sudden unemployment, financial insecurity, and uncertain futures. The laid-off HP employees, automotive workers, farmers, and countless others across affected industries represent the human dimension of policy decisions that often seem abstract and distant. The situation remains fluid, with policy changes and corporate responses evolving rapidly. HP's CEO, Enrique Lores, has stated that price increases are a last resort, but some targeted increases are assumed, given the tariff-induced cost pressures. This reflects the difficult choices facing businesses as they navigate the new economic landscape created by tariff policies. For consumers, the combination of higher prices and reduced product availability creates a troubling scenario reminiscent of pandemic-era shortages. The potential disruption to essential items like over-the-counter medications, air conditioning repair parts, and school supplies could have significant impacts on daily life, particularly for vulnerable populations with limited resources to absorb higher costs or find alternatives. Perhaps most concerning for long-term economic prospects is the potential impact on innovation and competitiveness. The tariff-induced disruption to global supply chains threatens to undermine the collaborative innovation ecosystem that has driven technological progress for decades. As companies like HP restructure their operations to avoid tariffs rather than optimize for innovation and efficiency, the pace of technological advancement could slow, with negative implications for productivity and economic growth. The impact on small businesses is particularly severe, as they lack the resources and global footprint to navigate these disruptions as effectively as large corporations. The inability to make long-term decisions due to rapidly changing policies creates a paralyzing uncertainty for small business owners, threatening the entrepreneurial dynamism that has historically been a key driver of American economic vitality.
It's hard to make a decision. We had an idea yesterday after the announcement of, well, maybe we can export to Australia, repackage the products, and then re-import them from there. But because policy changes every 36 hours or so. I don't want to make that decision and make that move only for something else to change in just a couple more days. I'm paralyzed. I can't even make a decision right now.
The path forward remains uncertain, but the evidence suggests a challenging period of adjustment lies ahead. The resilience of American workers and businesses will be tested, and the ultimate outcome will depend on how effectively we navigate these unprecedented economic disruptions. What is clear is that we are witnessing a fundamental transformation of the global economic order, with implications that will be felt for years to come. Click on one of the cards on your screen to see more videos like this.